Sure.
Michael Green. Michael is the chief strategist and portfolio manager at Simplify. So, Michael, I also saw a clip of you being on CNBC, and I've looked at some of your views. And the way I like to start, and I know I want to get to the markets, but it's always interesting to find out how somebody got started in this industry. What were you doing before you entered the trading business, and what was perhaps your first job in the industry? Time machine time.
Well, so I have a pretty traditional background for the industry. I went to the University of Pennsylvania Wharton School of Business for undergraduate, graduated in '92, went into management consulting. But prior to that, while I was still at Wharton, I worked for Spear, Leeds and Kellogg and traded crude oil futures on the New York Mercantile Exchange.
Nice.
And that was I was trading those crude oil futures when Saddam Hussein invaded Kuwait. And for those of you who have seen me or met me in person, I'm actually quite a large person. And so they used to hire people basically for size in the physical pits. So intelligence had absolutely nothing to do with it.
Ever have any out trades?
What's up?
Ever have any out trades?
I couldn't hear what you said. I'm sorry.
Ever have any out trades as a floor broker?
Out
trades are a thing. You come in the next day, you think you have all your trades matched up during the day, and it's an I don't know. Someone doesn't know it.
Yeah, no. So everything I did was through Spear, Leeds and Kellogg, and was actually internal to our option hedging position. So there would be no equivalent of an out trade.
Okay, so it was open outcry. A lot of guys had lost seats over it.
Right.
That's why I had a seat too, and I would hand off my order. I didn't want that risk.
Exactly.
So, okay. So let's talk about the data now, Michael. So go ahead. You think that the market's going to cheer this?
I think it's difficult for it not to, right? I mean, the biggest concern has been a growth slowdown. We see a combination of basically all of the headline components suggesting modest improvement. If I'm just actually going through the data as we speak right now.
Okay.
The nice thing is that you return to growth in the labor force. So we had fallen by about 400,000 last month. This month, it appears that we've largely reversed that. So we're relatively stable in this kind of 164 range. 164 million in terms of the labor force, so that's a net positive. Broadly speaking, and I write for commentary and do some of my shorter term technical analysis stuff through a firm called Tier 1 Alpha that I'm also involved with. And what we've been highlighting there is the dynamics of market positioning. People just got really bared up and managed to put themselves into a position in which I would argue that, particularly on some of the systematic strategies in the equity markets, they just got themselves too negative, and the positioning was way too light. And so part of what I think we're seeing right now is, if the world doesn't fall apart, this creates conditions under which people are kind of forced back into markets. Now it looks like it's tempering itself a little bit here. So it doesn't.
Okay, well, is that contrary to your belief we're in a bear market? This is
I think we're absolutely rally. In a bear market. I think this is I think this is the relief rally associated with the bear market.
Okay, and do you have any kind of levels where you think it might extend to?
I actually think we could, I have to be very careful in terms of offering trading advice, but for me, there's the potential for anywhere from a 5 to 10% rally in the SPOOs from these levels, which feels pretty significant given what we've just gone through in terms of the last week. But this is people forget how far we've come, right? I'm basically just describing a situation where we repeat the relief rally from March.
Okay, maybe 4,400 or so, right?
Yeah, I'm just pulling it up on my screens here, right? So that would be
okay. I'm looking at everyone's a little bit bulled up about China reopening, Michael, and copper
I have a very different view than most.
I know. Well, if you let me finish. I was going
What's
to
up?
say that you were skeptical about a China reopening. And
Yeah, I mean,
can you
and I think
tell
we
us about
continue.
that?
Yeah, sure. So look, the underlying dynamic is that China has closed the doors on its economy and has significantly reduced the ability to either leave or return to China, and has offered a narrative internally to China that is radically different than I think what we're experiencing elsewhere in the world. Um, when you do that, you either have to have a plan to transition, the fake news effectively that you have offered to your population to a more accurate news stream, because you'll have conflicting stories coming from abroad, or you have to decide that it's not really worth it. And I think what we've seen consistently with the COVID dynamics, the COVID zero dynamics, is the continued language of shutdowns are going to be lifted. COVID cases are falling, only to be replaced immediately by, well, there's a spike and they're not going to reopen and they're going to lock down again, et cetera. I just don't know how they reverse it. And the history of this is fairly straightforward. When authoritarian regimes shut, they don't reopen easily.
Okay. Okay. So basically, they're closed down for business. Do you think it's a prelude to something? There is a lot of geotension over Taiwan.
I think that there
I'm
is.
hoping not, but what do you
Yeah,
think?
no, I think there are a lot of concerns over Taiwan, and that seems like the logical play, right? I mean, you construct all sorts of dynamics and fantasies, but this is a very similar setup, and I've been arguing this for about 5 years. This is a very similar setup to the dynamics around the breakdown of the League of Nations in the 1930s and
Yeah.
the Molotov-Ribbentrop Protocol between Russia and Germany. This is just flipped and happening on the Eastern Front as compared to the Western Front.
Yeah, it reminds you of another period in history. A lot of parallels. What about the parallel with the 70s as far as inflation and where the Fed is going? I know people that don't think they're going to flip until the fall. And
When you say flip, you refer
well,
flipping back to easing conditions, or?
yeah, at least, for them to make a pivot. Do you think that they might complete or at least say that they're going to wait after another hike or two to see what develops? Because I don't see how they can really bring down the price of beans and corn. They can't print it. And, agricultural commodities have a different dynamic. They're not as economically sensitive as maybe copper or oil.
Well, so I think that there's a couple of components there. One is that when you have a strong, this is in part why you should be somewhat cautious about how to interpret a reasonably strong employment report. The most positive thing that I would argue that came out of this report, again, is the uptick in inflation and the increase in the labor force, because from the Fed's perspective, that will provide some help towards reducing labor pressures in the economy, which they're obviously concerned about. In terms of their ability to print beans and corn, we know that they can't do that, and they know that they can't do that. And so they have to be doing something else, which is trying to target aggregate demand by reducing employment, or at least the growth of employment, as Mester referred to yesterday.
Right.
I'm highly skeptical of this. And so I would just highlight that this May report doesn't yet reflect the consequences of the hiring freezes that have been announced, et cetera. The ADP report highlighted that small businesses have really been struggling. So my gut tells me that, and my gut, the analysis that you saw me talk about on CNBC, and that concerns me most is that the Fed, rather than sticking to its transitory narrative and focusing on the supply chain aspects of this, has been forced, due to political realities, to appear to be doing something under the threat of losing their independence.
What do you think their meeting, Paul's meeting with Biden was about? Any grand bargain? Paul probably remembers when the maestro stayed tight too long and Bush did not get reelected. during that term. I mean, tightening into a midterm like that obviously isn't, going to help Biden, whose popularity is in the basement anyway.
Yeah, I think that's correct. And I would broadly argue that while the Fed is not perhaps that political, they are kind of trapped in a mode of being forced to do something. And so just like last year, they dismissed concerns about accelerating inflation and risks to supply chains not untangling in a reasonably short time period. This year, they're forced into the other side. They flipped and said they see no signs of economic slowdown. And that obviously does not match with the data sets that we're seeing. So again, anything that provides some cover is ultimately going to be interpreted bullishly by the market. The caveat to that, right, and this is one of the things that you hear me talk an awful lot about, is we're discussing fundamentals, and the fundamentals are very slow to react. They're very slow to move, whereas the technical features of the market are very mechanical in nature. And so part of what we have been struggling with in the past several months has been a significantly higher level of realized vol than it was priced into volatility contracts, i.e. options, when they were initially entered. There was a significant need to take taxable gains entering into 2022 that people delayed in 2021. And so we saw a combination of profit taking and leaders who happen to be the largest names, and thereby taking down the index in a manner that the same type of activity didn't show in the smaller names in 2021. And I would broadly argue that you're seeing a lot of pressure around liquidity, and some of the liquidity indicators, things like Bitcoin, broadly suggest that this continues to be a bearish environment in aggregate. But the very mechanical nature of things like volatility targeting strategies, et cetera, simply means that if today doesn't end up being, a 3% down day, for example, you're going to continue to see strategies that had stepped to the side in the markets, things like insurance volatility targeting strategies. They're going to be forced to come back in mechanically because of their algorithms.
What are production costs, Michael, in Bitcoin?
Well, that's actually an interesting question. So depending on who you want to listen to, whether it's the Bitcoin proponents or the people that are tied into the space, most people have not updated their models for the significant increase in energy costs. Right. Our estimates are that the price of Bitcoin on average is about 23,000, and that you're approaching an inflection point in which some of the larger miners could become vulnerable as early as 25,000. A lot of these miners have also stocked up their Bitcoin rather than selling their Bitcoin. And as
you also
result,
say they have debt issues. They've leveraged some of this out too, haven't they?
Exactly. So you could actually see forced Bitcoin selling that pushes it significantly below those production cost levels.
20,000.
We think it's actually around 23,000, with some of the larger ones even being as high as 25,000.
Okay. Is this going to just turn out to be, when we look back in history, as just a part of the bubble, and Bitcoin really gets crushed over during the bear market in equities, perhaps into the fall or so?
Well, that would certainly be my expectation. I think that the degree of deception and fraud that exists within the Bitcoin universe, everything ranging from the type of discussion that we're having around production costs to the improper claims that Bitcoin relies exclusively on renewable energy. It's not a coincidence that we're seeing many of the challenges and shortages, and New York State, for example, just introduced a moratorium on Bitcoin mining in the past day. I think we're going to end up finding that there is an awful lot of fraud and misrepresentation in the space, particularly as it relates to things like stable coins on Tether.
The altcoins, I've heard people say if you believe in,
are actually kind of fun, because for just the simplest reason, they're basically outright garbage. 99 out of 100 of them.
Yeah, they're like pink sheet stocks, right?
Yeah, And we saw that last year, right? I mean,
Yeah.
you know, Coinbase, which is of course now announced layoffs and rescinded offers, which is about as negative of an outcome as can occur, short of, you know, an outright significant distress condition. You know, they listed, I believe the number is something like 4,000 tokens last year, right? You know, that makes Jordan Belfort in his best years look like he was sitting still.
Interesting. You have a view on the dollar, Michael? Does it come into play with your analysis of the markets and whether you favor domestic or possibly looking out to some of the markets that have suffered under the weight of a strong dollar?
Well, I would again broadly point to the dynamics of if the economic data in the US remains relatively strong versus the rest of the world, and in particular versus the Euro region, which has turned to a significant terms of trade imbalance where Europe largely sells consumer durables and largely imports raw materials. And their capital goods sales to China are basically shutting down. I don't know if you caught the headline that Germany is no longer willing to guarantee Volkswagen's foreign direct investments into China, for example. You know, this is the equivalent of raising insurance costs of doing business in China quite dramatically. You know, under both those conditions, you're creating a situation in which the two primary rivals to the US dollar, the Chinese yuan and the euro, are functionally weakened on a structural basis versus the US dollar.
Okay,
And
so this is just a little bear market rally bounce in euro. Do you have a different view? You know, just like there are different sectors in the market, commodity currencies seem to be acting pretty good. The Aussie and the Canadian, Canada, this is strong.
So again,
Canada.
a lot of this can be explained by the terms of trade dynamic.
Yeah.
Commodities have obviously done extraordinarily well. I'm a little bit more concerned about the economically sensitive commodities, things like oil and the metals in particular, in part tied to the dynamics around China. Now, some of that is tempered by if China goes into Taiwan, obviously any form of military grade commodity, which would include energy and copper, for example, are going to face significant potential supply disruptions, both in terms of transport and in terms of the ultimate end demand. And ultimately,
that was a huge move yesterday in copper, Michael.
Yeah. Although that was largely tied to Shanghai news. So I'm
that they got to go out and breathe fresh air.
They actually got to go out and you know,
I'd hang myself.
Well, that's a population reduction strategy.
Under those conditions, you know, throw a claustrophobic person to lock them up for a while. Anyway, so what are you doing with, I admit you probably can't get specific, but there are some people that are starting to turn friendly towards the bonds. You know, I think we're going to probably print new lows first, but do you see anything there? And is this the first time you've seen no bid in bonds during periods of risk off? It's been a long time since I've seen it.
Well, we saw that in the COVID dynamics as well, right? And it's more broadly reflective of, you know, what I would describe as liquidity conditions rather than demand conditions. You know, everybody kind of wants things to resolve at once, right? That's the quote unquote fun part.
Immediate gratification.
Immediate gratification, right? A crash is more fun than the slow decline that we have lived through, for example.
Right.
Bonds have, for all intents and purposes, crashed already, and the degree of rate hikes that have been embedded into the curve, we're seeing very clearly are having significant real world impacts, and that, you know, ranges in everything from housing affordability to reduced investment intentions from businesses, et cetera. You know, many of the in that CNBC conversation that you saw the other day, I highlighted the dynamic of a rapid increase in zombie companies. So
yes, in the Russell.
What's that?
In the Russell 3000, I believe you said 25% are zombies.
About 25%. There's about 700 companies in the Russell 3000 that are incapable of earning enough to meet their interest obligations, right? So they're either unprofitable or they're incapable of servicing their interest and therefore need to refinance. We've seen a dramatic slowdown in high yield issuance. We've seen a dramatic slowdown in investment grade issuance. Investment grade is not such a big deal, but high yield, you have to remember that these companies continue to make their interest payments. They continue to have to make their principal payments on their debt, and they continue to have to operate their businesses. And if they can't refinance their debt, then they're facing significant cash shortfalls that can ultimately result in significant distress emerging.
They actually look, HYG had, check out HYG. This is the bounce it had. Here's sovereigns, TLT based on sovereigns. No, it's a 10-year here. Look at this compared to high yield. And then corporate high grade, even better than sovereigns. But the relative strength I see so far in the bond market is the first bounce we've had out of the hole by high yield. Any reason for that?
Yep, and I think that's right. And so I would broadly actually highlight those dynamics, right? So people were super short HYG.
Right.
We actually have a credit hedged product that accesses HYG in a synthetic form. If you had been willing to take the counterparty risk of accessing HYG through what's referred to as a total return swap, you could pick up about 300 basis points of excess return. In this short covering rally, that number dropped to 150 basis points. So in other words, the demand to cover shorts was huge. A reasonable technical interpretation of that chart would be that they're all going to revisit their lows, right? You see the positive divergence.
I think that U.S. government debt will take out the lows. I don't know if high yield will take out the lows here. I don't know
if it'll take out the lows, but I would suggest that this looks an awful lot like what we saw back in March.
Okay.
Right? So similar positive divergences.
This in March.
Some consolidation. This has been stronger, obviously.
Yeah. This looks corrective, and this looks impulsive to me. Did you know that R.N. Elliott was compulsive? He used to wave to everyone on the street, but his wife was corrective, so it all worked out.
Only if he did it 5 times.
What's that?
I said only if he did it 5 times.
Yeah. So there's a lot of ground we've covered, Michael. After talking to you, what do I do during this time period if I'm not a trader or I don't want to buy bearish ETFs or short things? And bonds have been under pressure. Gold, if you're still a dollar bull, I would assume you probably don't. I'm neutral
on gold, right? So it has similar characteristics to things like Bitcoin, where it is both a liquidity play and a crisis play, right? So the dollar benefits from loss of liquidity, and broadly around the world, people are struggling to obtain access to dollars. We see this in the cross basis trades, et cetera. So to answer your question in terms of what do you do? I mean, the first thing is that I got to be extremely careful in terms of offering any form of financial advice, right? So I'm very limited in terms of what I can say. Right. I think I've been fairly clear that we are in a bear market, what I would describe as a bear market rally. That the Federal Reserve has misdiagnosed what is underway and believes that it is forced to do something in terms of hiking interest rates that will contribute to the shortage of and quantitative tightening is just another example of this.
Just started.
It just started. The really key thing to remember about something that's just starting is that it's a little bit like, turning on the water in a series of bathtubs, or starting to drain the water from a series of pools, right?
Yeah.
It's a gradual process. It's not a stop start. And so again, one of the things that I think people have spent too much time worrying about is when it starts versus when does it really begin to impact. And so the slow withdrawal of liquidity you know, if you just imagine it in terms of a series of pools that you're drawing it down from,
Yep.
you got to watch that first pool that'll be drained. You know, Bitcoin could very well be one of those first pools, right? Things that rely very heavily on excess liquidity.
Okay. You know, Michael, it's great to meet you and talk to you and get your views. Listeners and people that are here now watching it live can follow Michael at Prof Plum 99. Why that handle, Michael? Because you feel like you're an investigator of what's happening under the surface of financial markets. Prof Plum
wish
had
that
the clue. Huh?
I wish that it were that serious, actually. So I mentioned that I had the relatively traditional background. I actually went from the undergraduate program and had started a PhD program. And the joke was, you know, if you think of the game of Quill, my name is Green. Mr. Green is one of the characters in there. And so as a joke, I originally adopted the Unix email handle of Prof Plum, and then when we transitioned into the internet age, Prof Plum was taken, but Prof Plum 99 was not. And so it was totally unintentional that I ever became well known within the social media sphere.
Okay, and I know something that's near and dear to your heart is a charity, the Children of Haiti. How did you get involved with that, and how can people help? Here we go.
My primary charity is actually an institution called Coney Island Prep, which is a school, charter school that's based in Brooklyn, New York.
Cool.
The Children of Haiti project, this is something that my youngest son, who's headed off to the U.S. Naval Academy in a couple of weeks, became involved with, and he had asked me for some assistance in terms of helping him and his peers in raising money for a group of students that they had partnered up with in Haiti. These are children that became orphans in the aftermath of the Haiti earthquake. A school was founded for them. And the first class of graduating students from this originally middle school, and it's very similar to the pattern that was followed with Coney Island Prep. The first graduating class is now headed off to college in Canada, thanks to some of the funds that we and others have raised.
Okay. Michael Green, you're now my trading warrior brother. You awesome. Let me interrupt you about, I don't know, 15 times.
That's
I think
okay.
Anyway, so we appreciate you being here.
Thank you very much for inviting me.
Yeah, perhaps we could do it again, and wish you all the success at Simplify and in your charity work and communicating difficult financial conditions to the public. Not easy.
Thank you very much. I appreciate that.
All
the best
everyone.
to you and your team.
Thank you. Follow Michael at Prof Plum 99, and I hope everyone has a great weekend, recharge, and know what you're going to do next week over the weekend before the markets open. Have a plan. You could join the team in 15 minutes for the morning edge. And again, don't just count your pips, count your blessings. See everyone next week. Adios, and thanks again, Michael Green.
Thank you.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.